and gentlemen, good day and welcome to Satin Creditcare Network Limited Q1 FY2026 analyst conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Mayank Mistry from JM Financial Institutional Securities Limited. Thank you, and over to you, sir.
Thank you, Palak, and good morning, everyone. On behalf of JM Financial, I welcome all participants on the call and thank the management of Satin Creditcare Network Limited for the opportunity to host this call. For today's call, we have with us the members of the management and the leadership team of Satin Creditcare Network. From the management team, we have Dr. H.P. Singh, Chairman and MD, Mr. Jugal Kataria, Group Controller, and Ms. Aditi Singh, Chief Strategy Officer. I now hand over the call to Dr. H.P. Singh for his opening remarks, post which we can open the floor for Q&A. Thank you, and over to you, sir.
Thank you, Mayank. Good morning, everyone. Thank you for joining us to discuss our company's performance during the first quarter of the financial year 25-26. As we hear the news of floods and heavy rainfall in a few regions, I hope you and your family are safe and keeping healthy. I believe you have had the opportunity to go through our quarterly results and investor presentation. They can be referred through our website or the stock exchanges. I am pleased to share that we have released our 6th annual integrated report for the financial year 25, and it's available on the official website of our company. I warmly encourage all stakeholders to explore it. This year's theme, Legacy, Leadership, Composing the Unwritten, offers a comprehensive lens into our organization. It presents an in-depth view of our resilient business model, built over the years, and showcases our integrated performance across financial strategy, non-strategy, and ESG dimensions. I must say, when I look back at the journey we have taken, the path we have walked, and the mark we have left on countless lives, I feel a deep sense of pride in how far Satin Creditcare Group has come. For us, inclusion has never been just a term, it has been our way of life. Our path has been anything but linear. It has been shaped by vision, curiosity, willingness to question ourselves, and courage to take the road less traveled. In our effort to unlock the potential of India, we have constantly asked ourselves, what's next? What else is possible? And this mindset has led us to explore new ideas, challenge assumptions, and step into areas where others often hesitate. We gave ourselves the freedom to try to build, to innovate boldly. This willingness to go beyond the conventional is not incidental, it is central to who we are. Each one of our subsidiaries reflects this mindset. They have emerged through purposeful exploration designed to solve real problems and address unmet needs. We have created differentiation through diversification. Whether it is stepping into affordable micro-housing, which still remains a niche yet essential space, or addressing the needs of the missing middle through our MSME offerings, those who are too large for microcredit and too small for traditional lending. Our approach has been thoughtful and future-facing. We call it creating value through purposeful diversification. Our investment in technology and the knowledge we have built internally gives us the confidence to go a step further than merely supporting our business. We saw the potential to share our capabilities so others too could benefit from practical, locally relevant solutions, which gave birth to Satin Technologies Limited. Now, carrying that same spirit forward comes our newest initiative, Satin Growth Alternatives. A women-led AIF debt fund, this venture marks another forward-looking move. The fund will focus on enabling access to capital for underserved MSMEs across India, particularly in rural and semi-urban regions, with a strong focus on enterprises led by women and ESG. Now, some may wonder why pursue such broad diversification, and to that we say, why not? In a nation of over 1.4 billion people, where every community has its own needs, its own dreams, and its own challenges, we believe our solution must be just as diverse, because real inclusion is not one size fits all. It is about recognizing the uniqueness of lives and responding to them with intention, with courage and with care. And that's what Satin Group stands for. Now coming to the performance of the parent, the listed entity, SENL, we continue to demonstrate strength where it matters most: consistency, resilience, and value creation. In an evolving economic landscape, we have not only stayed grounded but also stayed ahead of the curve through the efforts made. Over the last 6 years, we have maintained one of the highest average ROA at 2.1% and ROE at 9.1% amongst our listed peers. We have also managed risk prudently. Our average credit cost over the same period stands at 3.3%, the lowest in our listed peer group. Our capital adequacy has remained well above the regulatory requirement, consistently staying above 25% in the last 6 years, providing us with ample headroom for growth and innovation. And none of this would be possible without the people who drive this engine. One of our biggest strengths is the consistency and commitment of our leadership team, with an average tenure of nearly 10 years of our CXOs. In an industry where leadership changes are not uncommon, this level of continuity ensures a clear long-term vision. Coming to the performance of the quarter, we have begun the financial year with firm steps and maintained consistent momentum in both our operational and financial numbers. However, since a significant portion of our portfolio is linked to agriculture and allied sectors, the first quarter typically experiences a slowdown due to the harvesting cycle and heat waves, which naturally makes this period more challenging in terms of credit demand and operational efficiency. Despite these factors, we are pleased to report our 16th consecutive profitable quarter. This is a great achievement, particularly in a quarter marked by seasonal headwinds, ongoing cyclical pressures, and in sector-reported degrowth of 21% based on the average of peers who have declared their results. Talking about our operational performance during the quarter, we continue to expand in a calibrated and sustainable manner. On a consolidated basis, in terms of growth, our AUM grew by 6.8% YOY to Indian rupees 12,499 crores. On a standalone basis, our gross loan portfolio stood at 10,956 crores, reflecting a growth of 4.5% on YOY basis. We also maintained consistent disbursement momentum with 2,242 crore disbursed on a consolidated basis, up 6% on year-on-year basis, and 2,065 crore on a standalone basis, marking a growth of 3.4% year-on-year. Sorry. Our network continues to expand its reach and strengthen our presence across the country. On a consolidated basis, we now operate through a network of 1,599 branches, reflecting a growth of 10.5%, covering 519 districts across 29 states and union territories. On a standalone basis, the branch count increased by 14.3% to 1,487. I would like to apprise you that our growth strategy continues to focus on deepening our presence in high-performing regions while identifying new markets that align with our financial inclusion goals. Building on this approach, we marked our strategic entry into Mizoram in July 2025, further strengthening our leadership footprint in the Northeast, a region that has consistently demonstrated strong portfolio quality and customer engagement. This extensive geographical presence gives us a strong distribution platform to better serve economically disadvantaged and remote markets, further reinforcing our commitment to financial inclusion. As of the quarter end, our consolidated client base stood at 32.9 lakhs. We would now like to draw your attention to slide number 19 in the investor presentation on the asset quality update. Our PAR 90 levels remain stable at 3.7% as of June 25, in line with March levels. This stability is a strong reflection of our portfolio quality and the continued discipline in our risk management practices. It also underscores the deep client engagement that has long been a strength of our operating model. We did observe a slight uptick in PAR 1. It stood at 5.8% during the quarter. This was expected given this was driven by seasonal factors, particularly the harvesting period, heat wave, and unusually heavy rainfall in some geographies. There was also a base effect at play given the relatively slower disbursement during the quarter. Despite these conditions, we remain well buffered. As of June 25, we hold on-book provisions of 316 crore, which is 3.6% of the on-book portfolio, significantly higher than the RBI requirement of 177 crores. In addition to this, we have created a management overlay of 8 crores during the quarter. Our stage 3 coverage ratio has improved to 63% compared to 61% in June last year, which again reinforces our focus on prudent provisioning. During the reporting period, we have recovered around 8 crores against the written-off pool, another marker of the strength in the system. We also took proactive steps this quarter to further strengthen credit quality. Following the implementation of Guardrails 2 from April onwards, we tightened our credit evaluation framework, which led to an increase in application rejection rates to 67%, up by approximately 300 basis points since March 25. As of June 25, only 6.1% of our clients had exposure to more than 3 microfinance lenders, and just 0.1% had loan exposure of 2 lakh or more at the time of disbursement. These indicators clearly reflect the strength of our credit controls and our ongoing commitment to prudent lending. Moving to the financials for the first quarter of the financial year 25, our revenue grew by 10.3% year-on-year to 642 crore and by 14.3% on a quarter-on-quarter basis from 562 crore. Net interest margin remains stable and consistent, standing at 13.48% during the reporting quarter compared to 13.38% in Q1 25 and 11.81% in Q4 FY25. Our operating expense ratio stood at 6.80% on a consolidated basis and 6.68% on a standalone basis. While the ratio remains elevated when compared to the same period last year, largely due to sector-wide challenges, it has shown sequential improvement. This improvement is a result of our ongoing cost rationalization efforts as operational conditions begin to stabilize. Loan loss ratio on a standalone basis stood at 4.84%, slightly elevated due to the inherent seasonality of the period, along with a reduction in AUM on a quarter-on-quarter basis caused by muted disbursements and write-offs. That said, we are actively managing this through strengthened collection and tighter portfolio monitoring to ensure stability in the coming quarters. On a consolidated basis, return on assets and return on equity stood at 1.50% and 7.06% respectively, while on a standalone basis, they stood at 1.51% and 5.97%. We reported a PAT of 45 crore on a consolidated basis, whereas 43 crore on standalone basis for the quarter, reinforcing our ability to maintain profitability even in a stressed first quarter, establishing us as an outlier. Coming on the borrowing front, we continue to operate on a strong and well-balanced funding base. The company's financial position remains strong with CRAR of 26%. During the quarter, the company has adequate liquidity of approximately 2,000 crores, coupled with undrawn sanctions of 401 crores. This financial strength reinforces our stability and further strengthens stakeholders' confidence in the company. On our targeted credit cost for the financial year 25-26, we are targeting a reduction compared to FY25, where it stood at 4.6%. While we remain mindful of the evolving environment, we are committed to strengthening both our financial and operational performance through disciplined execution, deeper field engagement, and a continued focus on serving our customers responsibly and sustainably. I'm also pleased to share a significant development during the quarter on the governance front. We further strengthened our board with the induction of 2 highly distinguished professionals, Mr. Ashok Kumar Sharma, former Executive Director of the Life Insurance Corporation of India, and Mr. Anupam Kunal Gangar, a seasoned chartered accountant, as independent directors. We are certain that their expertise will add meaningful value to the board and support the organization's long-term strategic vision. Our commitment to responsible business also extends beyond compliance. It is deeply rooted in our approach to environmental stewardship. By understanding our carbon footprint, we are driving targeted actions to reduce emissions and contribute to global climate goals. Furthermore, in financial year 24-25, we conducted our first formal materiality assessment. This exercise enabled us to identify 21 material topics that highlight the key areas we need to focus on based on a rigorous 4-step evaluation process. Coming on the recognition front, we are proud to share that Satin was ranked 57th amongst India's great places to work for 25 and was honored as the Microfinance Institution of the Year at the FinVision AI Excellence Award. These recognition reaffirms our values of innovation and inclusion and reflect the collective efforts of our team and the trust placed in us by our clients. Speaking of the industry, we strongly believe that microfinance is not just a promising sector, it's a critical one. With nearly 70% of India's population living in rural areas and a significant portion still outside the formal credit system, the demand for small-ticket need-based financing continues to grow. Microfinance fills this gap with purpose and precision. As highlighted in the Avendus Capital Report, the sector is currently navigating a transitional phase, but the groundwork being laid today is expected to yield resilient and profitable operations in the coming cycle. We fully resonate with the view and remain confident in this role the sector will continue to play in driving inclusive and sustainable development across the country. Now sharing with you financial and operational heights of our company, starting with the consolidated highlights. We have a customer base of around 32.9 lakhs as on Q1 FY26, with presence spanning in 1,599 branches across 519 districts in 29 states and UTs of India. Our top 4 states contribute to 56% of total AUM as at Q1 FY26, and the states are UP, Bihar, Assam, and West Bengal. Standalone highlights: our average ticket size of FMI lending for the reporting quarter stood at 56,000 rupees. We have a well-diversified customer base of 32.2 lakh clients with 76% rural exposure, pan-India presence with 1,487 branches. The shareholders' equity stood at 2,870 crore as on June 25. GNP as on June 25 stood at 3.7%. The overall provision coverage ratio increased to 97% in June 25 versus 91% in June 24. Total borrowings stood at 8,328 crores as of June 25. Debt to equity ratio as of June 25 stood at 2.9x. As on June 25, 97.7% of our districts have less than 1% of AUM. An update on subsidiaries. As a one-stop diversified financial services provider for rural India, our subsidiaries work collectively to expand financial access. Leveraging our strong microfinance outreach, we provide affordable housing and retail MSME loans to clients who have completed 2 or more loan cycles with us and require higher credit support. Satin Housing Finance Limited has now reached an AUM of 961 crores, which grew by 25% YOY, having presence across 20 states with 9,432 customers. SHFL has a 100% retail book, GNP of 3.1% as of June 25. The company has 34 active lenders, including NHB Refinance, CRAR of 48.3% and gearing of 2.3x. PAT for Q1 FY26 stood at 57 lakhs. Credit rating of A- stable from ICRA. Satin Finserv Limited, the company's MSME lending arm, has reached an AUM of 582 crores. We are running down the business correspondent book and focusing on building the retail MSME book. MSME on-book portfolio grew by 56%, CRAR of 36.8% and gearing of 2.4x. PAT stood at 1.9 crores. 21 active lenders, including banks, impact funds, etc. Credit rating of A- stable from ICRA. Lastly, thank you for joining us today and for walking alongside us as we build a stronger, more inclusive, and more purpose-driven future. With this, I would like to open the floor for questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may please press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may please press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Shubhranshu Mishra from Phillip Capital. Please go ahead.
Hi, good morning. 2 questions. The first one is concentration in the top 4 states, which is UP, Bihar, West Bengal, and Assam. Together, they are roughly around 56% of the AUM. So, what is our plan to de-risk from these states, which also have nascent to credit customers, as well as very politically active states, and there can be significant event risks which can create disruptions in our portfolio every 2-3 years. Second is with the qualifying assets coming off to 60%, how do we think of the OpEx? How do we model for the newer products? Will there be more of secured products or more of unsecured products? So if you can take us through the product roadmap and the related OpEx that will come along with it.
So let me answer your first question. I think, for you, if you look at the past 7 years, I think from demonetization, if you look at our percentages of delinquency in UP, Bihar, and the 4 top states, I think they have been negligible. So I think, for us to comment on deleveraging ourselves on the states where we are very strong as compared to anyone in the industry, I think, that's probably a myth which we would not like to take, and we would like to concentrate our whatever is. It's been steady at about 56 to 60%. This has been steady across the last, I think, 5-7 years, and we would like to concentrate on these states only. No reason for us to de-risk ourselves from there, but we are growing in other states also. So having said that, I think for us, we've put our ways of how we look at concentration risk across over there. The second point of looking at secured lending products, I think we are very well aware of the subsidies which we have. For us, it doesn't make too much of a difference to look at the qualifying asset portfolio norms now, because we already have 3 subsidiaries which are now working through, 2 in the financial service space and 1 in the non-financial services space. And I think we are going ahead by looking at increasing our portfolio over there. Housing having reached about 960 odd crores, and SFL looking at about 560 odd crores. So I think we are well geared to look at our operating performance through our investments and our subsidies to bring them over across to deleverage ourselves also from unsecured to secured lending.
Sure, thanks.
Yeah.
Thank you, sir. The next question is from the line of Naman Barjatya from AUM Capital. Please go ahead.
Yeah, hi. Thanks for the opportunity. So I just have 2 questions to ask. Firstly, if you look at it on a quarter-on-quarter basis at a standalone level, the company reported a slight drop in its active client base, approximately around 6%. So I would like to...
Can you repeat the question?
Hello?
Excuse me, can you repeat your question?
Your voice is not
Voice
clear.
is cracking up, yeah.
Am I audible?
Can you repeat the question, please?
Yeah,
You're audible,
sure.
but your voice is cracked.
Okay. So now it's better, I guess. Yeah. So if you look at a quarter-on-quarter basis at a standalone level, the company reported an approximately 6% drop in its active client base. So I would just like you to put some color on that to get a better understanding, why it did happen and how are you looking at it going. My second question is hello?
Let's answer your first question, then you can ask the second question. So the first quarter, if you look at, sequentially year-on-year is always very muted. However, for us, even in this first quarter, we have beaten our YOY projections. We disbursed about... Hello, can you hear me?
Yes, sir.
Naman, I think
Naman is...
Hello?
I think, have you been able to hear?
Yes,
I think we'll
Naman,
jump on to
sir,
the
can
next
you
question.
please
Naman, I think
join the
you
queue?
again,
Yeah, sure.
Thank you, sir. The next question is from the line of Mayank Mistry from JM Financial Institutional Securities. Please go ahead.
Yeah, hi, sir. So my question is largely on the borrowing front. I mean, we have seen some increase in cost of funds during this quarter. So is it like banks have actually increased their rates largely to the NBFC MFIs, or what is driving this increase?
So Mayank, it is not the increase. It is because of the hedge accounting that there is some increase of about 27 odd crore in the top line, and 28 crore in the finance cost. Otherwise, the marginal cost of borrowing is slightly going down. We are close to about 11.1% or so in terms of marginal cost. It is because of the hedge accounting that both the top line and the finance cost is slightly showing as a higher number. But if you see the NIM, they are broadly stable and we are close to 13.5% NIM.
Yeah. So you said marginal cost of borrowings is 11.1. Our blended stands at around 9%. So I'm not able to connect.
So finance cost, what we have shown in the DuPont is that finance cost to average AUM. It's not on the borrowing.
Okay. My second question is on the increase in average ticket. Hello. Another question is on the increase in the average ticket size. It has moved up from 53,000 to 56,000 now, and even on the year-on-year basis, it seems like it has been consistently increasing. So, even on the ground, we are seeing that a lot of NBFC MFI especially are trying to find the higher chunk of the 2 lakh indebtedness which is allowed for each customer. So, are we also aiming for the same, or what is driving this increase in average ticket size?
See, for us, we are looking more at of our existing customers, basically who have a better credit quality and a better score. And that is the reason why I think, that has jumped up from 53,000, which is pretty negligible in terms of if you look at the average EMI, which comes every 14 days, so it is probably not very significant for us to really look at from 53,000 moving to 56,000, because our concentration more is towards our existing good clients, to look at portfolio quality in a much better holistic approach, rather than just looking at new to credit or new to Satin clients. Basically, that's what our approach has been.
Okay, sir. And just last question: when do we see the book being cleared out of these Satin plus 3 customers?
It's hardly anything, Mayank. It's just 6%. If you look at the entire industry, we probably have the lowest this thing, So I think, that's how, we've probably configured ourselves. If you look at the composition for us, close to about, if I have the figures, only Satin customers are technically 48.53%. These are the numbers. Satin plus 1 is 29.66%. Satin plus 2 is 15.76%, which means Satin plus 1 and Satin plus 2 are close to about 94%, There's hardly just 6%, which is at Satin plus 3. And this technically would be more of our existing borrowers rather than anything else,
Yeah, so actually,
I also give you a figure that after guardrails 2 has been imposed, this is not now being done. So this is out. This was previous to that. And now it's absolutely zero. So it's only Satin plus 2. And I gave you that number of 0.1% of any client attendance beyond 2 lakhs. That is what not we are doing. So basically there are a lot of filters which we put in across. And that's the reason for our portfolio quality being better than, a lot many,
Okay, sir. That's all from my side. Thank you and all the best.
Thanks, ma'am.
Thank you, sir. The next question is from the line of Naman Bharjatia from AUM Capital. Please go ahead.
Yeah. Hi. Am I audible?
Yes.
Yeah, Naman.
Yeah. So my question was that if you look at on a quarter-to-quarter basis, the company reported approximately 6% drop in its active client base. So just wanted to understand why it did happen and how are you looking at it going ahead?
So Naman, as I think, you couldn't hear at that point of time. So first quarter is always a very muted quarter.
Naman, can you hear us?
Can you hear us, Naman?
Yeah, now I'm able to hear you. And am I audible?
Yes.
Yeah, you are. So as I said, first quarter is always a muted quarter. But we have done better as compared to YOY. Basically, last year it was about 930 odd crores. This time we disbursed close to about 2,065 odd crores. So it's been better. Secondly, there's been a write-off of 112 crores. That is also one of the key reasons why there's a dip in that. And as I told you earlier, basically, the first quarter is always a muted quarter. But having said that, we are going ahead with our plans of, of our growth. And just for your consumption or for everybody's consumption who's there on the call, we are now opening close to about 188 branches this quarter to move forward and continue with our growth plans,
Okay. Thank you for this. And like you mentioned that because of the higher write-off, we saw a drop during the quarter. So like what exactly led to the higher write-off? Like was it because of sanctioning loans to poor customers, or what? Like what exactly led to?
Write-off is basically because of cleaning up of our portfolio quality. So ours, in fact, is one of the lowest write-offs, which is happening,
Oh, okay. Yeah, like, thank you. This was all I had to ask, and yeah, like, best of luck for the future.
Thanks, Naman.
Thank you. Yeah.
Thank you.
Sir, ladies and gentlemen, to ask a question, please press star and one now. Participants who wish to ask questions may please press star and one at this time. The next question is from the line of Prabhudayan Sharma, an individual investor. Please go ahead.
Namaskar, Mr. Singh. Today joining the Concall a little bit later. So may I know the ROE guidance and growth guidance?
No growth guidance, no ROA guidance. We are only giving you the present picture of where we are right now. And I think where we stand right now, I think it will probably be stable enough. I said the ROA was about 1.51% and ROE was about 5.6%. Overall consolidated was about 9%. So I think and we gave you, I think it's there in the investor presentation. If you look at the 6 years listed also, we have maintained our ROA of 2.1% and ROE of 9.1%. I think looking forward ahead, this remains stable within that range.
Okay. Thank you, Mr. Singh. Best of luck.
Thank you. Thank you, sir.
Thank you, sir. As there are no further questions from the participants, I now hand the conference over to Aditi Singh for closing comments.
Thank you, Palak and Mayank, for helping us organize this call today. And on behalf of Satin Creditcare, I thank each one of you for taking out time on a Monday morning and listening to our calls. I can understand the questions are limited because our growth is very stable and we are very consistent with our profitability numbers. So on that note, we conclude this call. We thank everyone and wish you a great week ahead.
Thank you, ma'am. On behalf of Satin Creditcare Network Limited, that concludes this conference call. Thank you for joining us, and you may now disconnect your lines.
If you found this video helpful, please like, share and subscribe to Concall India for latest upcoming Concall.